Merck employees, and welcome. Thank you so much for joining us today. I'm Sam. I'll be moderating this presentation for you, and in just a second, we'll be joined by Wesley Boudreau, one of our financial advisors. We're just going to wait for a couple other people to trickle in here today. Before Wesley gets started, just a couple housekeeping items for you. First and foremost, please be reminded that we are not Merck here. We are not affiliated nor endorsed by Merck. We are a completely independent group of financial advisors, so please keep that in mind. I'll be moderating this chat and also monitoring the Q&A box. You'll see that Q&A box on your screen there. It is completely anonymous. Please feel free to ask away any questions you have while Wesley's speaking. We encourage your questions. We love to answer them. I apologize in advance. We will not be answering them live today, but I will make sure someone can reach out to you afterward, either through phone or email, to speak to you about those questions and cover any concerns you may have mentioned in that Q&A box. Next, if you have a LinkedIn, feel free to connect with us over on LinkedIn. You can also follow us on YouTube. We post a lot of content for Merck employees and also retirees, and we really feel you'd get value out of it if you considered giving us a follow. You can also head over to our website. I'll be posting some links into the chat here. They're going to pop up right above Wesley's head. Head on over to our website. You can find our calendar there where you can book a free 15 or 30-minute block of time with one of our Merck-focused advisors who are very, very knowledgeable and experienced in all of the Merck retirement plans. And you can also subscribe to our blog. We have a lot of blogs for Merck employees and retirees, and we really feel those are a great way for you to stay updated on your retirement. So take advantage of all of those free resources. And with all of that out of the way and all that talking, I'm going to now push this on over to Wesley Boudreau to get started.
All right, thank you very much for that introduction, Samantha. And like she said today, we're going to be digging into the Merck pension plan. I'm going to kind of go through it at a high level. We do have some other webinars that go into the details. I'll kind of allude to some of that information. But ultimately, just give us a call or give me a call, and we'll be happy to kind of dig into your specific situation, help you run the numbers, and we'll talk a little bit about that cash flow analysis report later. So again, I'm Wesley Boudreau, one of the financial advisors here with the Retirement Group, now part of Wealth Enhancement Group. And as far as our focus, as you transition to retirement as a Merck employee, there are different sources of potential income you could have, because let's face it, we're giving up that paycheck that we've had for the last 15, 20, 30. In some cases, I've talked to individuals that have been there for close to 40 years or so. And what you can be seeing is we're going to have different sources of income. Hopefully, we're all going to have Social Security as kind of a core building block. You may have some additional savings and pension. So again, the 401k that you're going to have, and then also the pension plan you're going to have through Merck, where count yourself lucky because a lot of companies now don't have those pension plans. So it is an additional benefit that you have over and beyond a lot of the general public out there. And then as far as if those don't satisfy you, or maybe you're just bored, you need some additional things to do. You could have some other part-time work, or you may decide to leave Merck and go and consult or do something else in your spare time. So you could potentially have some job earnings as well. And then outside the typical savings and pension, hopefully you've actually saved some outside of those plans as well. You may have some after-tax money that you built up into a brokerage account, or maybe you saved some in a savings account, or maybe you even built up your own Roth IRA or something like that. So as you transition from Merck, the question is, okay, how do I recreate my paycheck? How do I actually take my own money and pay myself throughout the next 30 plus years or so of retirement potentially? And what we're going to talk about today is not the 401k, but the pension plan. And like I said, I'm going to go over some high level here. If you want more details, just give us a call. We'll be happy to dig into that on a one-on-one basis for you. So quick summary. As far as the pension benefit plan, you're going to have potentially two different options depending upon when you were hired. And that cutoff time is going to be around 2013. So if you were hired before 2013, you're on the classic defined benefit plan, which is a formula that they use in order to calculate out what your single life annuity is going to be. And then from there, if you want to deviate from that, take a joint survivor or take a lump sum, which we'll talk about a few slides down the road, that will dictate what that specific payment is going to be. Now, I don't have the formula up here, but again, we can go through it one-on-one if you need to, but it does get a little bit more complicated because if you were hired before 2013, that gets you into that defined benefit plan. If you were hired before 2000, there's one formula for pre-1999 and one formula for post-2000. It's a little bit variation as far as the percentage, but ultimately the way they do it is they look at a percentage times your final average pay times your years of service minus the Social Security offset, because Merck has been putting in half your Social Security while you've been working in order to come out to what is my specific single life annuity. So let's say Wesley goes through there and and it comes out that I've got a lifetime income, single life of $3,000 a month. From there, I can calculate everything else from there and turn that into a lump sum or turn it into a joint survivor annuity. There's also a minimum formula. So if you maybe you're lower paid or hourly, and maybe come into a situation where you haven't accumulated enough, there's a minimum formula where they'll actually do 720 years, $720 per year of service. So you could run through that, and if your actual calculation comes out lower than that, you're going to bump up to that minimum aspect there as well. And then if you were hired after 2013, there's the cash balance plan, in which case you do have the option, you may have had that option to transition into one or the other. We'll talk about that on the next slide. But the cash balance plan is a little bit simpler because you kind of, what you see is what you get. They're going to be making contributions into that each year based upon the CPIU, which is the Consumer Price Index, plus 3%. And we got a chart a couple slides down the road to kind of go through what that's going to look like as far as based upon your years of service and your age to determine what percentage they're going to contribute each year, and it's going to grow at the Consumer Price Index plus 3% with a minimum of 3.3% on there, which we don't have any risk of hitting any time again. I don't think we did have that in 2020. We'll show you on that chart a little bit later, but going forward, I think it's going to be just the CPI plus that 3%, obviously. And so who qualifies for what? I mentioned again, 2013 was that cutoff time. So if you were hired after 2013, you're part of the cash balance plan. If you were hired before 2013, you're part of the classic defined benefit plan, which again is that formula based in order to determine what your single life annuity is going to be. And then you actually had the option if you the transition for if you were hired before 2013, there was a transition process where you actually can elect the calculate the benefits through 2019 using either formula, and they'll go through and determine what's the best option for you. So we don't have to do that one-on-one. That's something that when you run that pension calculation and that estimate, it's going to be all done for you. So we'll go through and give you those side by side. If you need help reviewing that, just give me a call. We can get a copy of your pension elections or pension estimate and show you what those different options are and go through the pros and cons of how to actually elect that. And there's also the improvement of retirement benefits as far as looking at comparing everything together on that estimate that we talked about there as well. As far as the payment options, no matter what your plan is, whether it's a cash balance plan or the classic defined benefit plan, you're going to have the choices of either taking an annuity, which means it's going to be a steady stream of income to yourself for the rest of your life, or you can actually change that to a joint survivor annuity if you want to make sure that your significant other is taken care of as well. Or you can say, I want to take a lump sum. Maybe I don't need that income payment or right now. I want to defer because I'm working somewhere else. Or maybe you say, I've got longevity issues. I don't think I'm making it past 75 or past 80 or something like that, and you want to take that money and invest it yourself. Or you just may say, hey, I want more control over it. I want to manage the taxes better. I want to actually invest this and try and grow it more than what that pension annuity would pay me. We'll go through all those different options side by side and a cash flow analysis for you if you want to see what that potentially plays out to be. But I'd say, to keep it simple, most people will elect that pension as the annuity if they've maybe got some spending issues. They want to make sure they have that fixed guaranteed income no matter what. They've got concerns about maybe mismanaging it themselves or work with a firm that may mismanage it. But if you think that you're able to control your spending, you're not going to mismanage the assets or get too risky with them, then usually it's going to be beneficial to look at that lump sum as well. But again, it's most beneficial to give us a call and look at these things side by side in a detailed cash flow analysis so we can show you how it plays out over the next 20, 30 years or so on both those different choices side by side. So as far as those choices, if we look at the bottom here again, there's that traditional benefit plan we talked about already in the cash balance plan, but let's dig into those income payments on the distribution. There's the single life annuity and the joint survivor annuity, and there's also going to be a lump sum we'll talk about. We'll talk about how the interest rates affect that as well for you, and those are going to change on a monthly basis, and for some of you it may be locked in on an annual or quarterly basis. We'll talk about in a moment. So the single life annuity, like I said, that's going to be the core calculation for the defined benefit plan, the one if you were hired before 2013. So again, they go through, they run the years of service, final average pay, the percentage multiplier, and the subtraction of the Social Security percentage to come out and say, like that example I gave before, let's say that I'm going to get $3,000 a month for the rest of my life. That's my single life annuity. So if I live 10 years or I live 35 years, I'm still going to get that $3,000 a month. No inflation protection. It's not going to have a cost of living adjustment in it. If I pass away earlier, then I'm going to lose out, or my family's going to lose out because I didn't get as much. But if I, lived, 25, 30, 35 years, 40 years in retirement, then I'm going to win because, again, I'm having Merck on the hook for paying me a lot longer on that. So as far as if I say, okay, well, I don't want to just pay out on my life. I'm married. I want to make sure that my spouse is covered in case something were to happen to me. Normally speaking, we pass away before our wives do. So let's say that I say, well, instead of that $3,000 a month, I want to make sure my wife is covered in case something were to happen to me. So I might do a joint survivor annuity, and maybe I can do a 50 or 75% or 100% continuation. So maybe I say I want a 75% continuation because I want to make sure my wife gets between half and maybe all of what we were getting before in case I were to leave, because if I'm gone, the assumption is some of that spending has been decreased as well because it's just her taking care of things. So I said a $3,000 a month because now Merck's going to pay it off based upon 2 lives, and there's a higher likelihood of one of us living longer. They're going to pay a lower amount. So it may be, instead of $3,000 a month, maybe it's $2,700 a month for the rest of my life. But if I were to pass away before, and I'm going to change the math, let's say we did a 50% joint survivor, instead of that $2,700, she's going to drop down to, what is that, $1,350 that she's going to get for the rest of her life if she lives another, couple years or 5 or 10 years. And so that's a way to make sure that, in case something happens to you sooner rather than later, your beneficiary is going to be protected in there as well. So again, it's important to run these numbers side by side and kind of figure out what you think your life expectancy estimates are. Because a lot of times we work with individuals where, we know there's health issues for one, and one may have longevity on their side. So in that case, maybe we do the 100% joint survivor if we're going to do that. Or again, if there's health concerns, a lot of times that leads towards that lump sum calculation being more beneficial because you've got more flexibility and control with that as well. So what is a lump sum? The lump sum, let's go back to the example I gave you in that $3,000 a month. And we're, again, talking about the classic before 2013 hired defined benefit plan. It's going to be a one-time payment. And so what they're going to do is they're going to take that $3,000 a month and look at me and say, okay, well, I'm 60 and life expectancy is 86. So I've got 26 more years of potential payments of that $3,000 a month. What are the current interest rates? They'll do what's called a net present value calculation to figure out, okay, we need to give Wesley, $605,000 for him to go out and recreate that same $3,000 a month. If interest rates change, we may need to give him $700,000. We'll talk about that in just a moment. But the goal is for them to give you a certain amount for you to mathematically go out and recreate that same paycheck. Now the question is whether you can do it or not. A lot of cases you're able to do that plus some because of proper management, but other cases you might have concerns about mismanaging it, or you may spend it too quickly because there's no guardrails on there. That's why it's important to work with a firm like the Retirement Group to kind of help you through that process and kind of manage or police you. At the end of the day, it's all your money. You can do what you want. I've filled up the phone calls where I hear slot machines in the background, but at the end of the day, we're going to guide you through it. A good example, I helped a client just last week, avoid about $12,000 mistake and a fraud or a scheme for a timeshare sale. Again, he was ready to do it. I started the process, but I got him to kind of rethink it. So again, at the end of the day, we can't fully control your money, but we're going to be there to help you and police you through that to help you manage it as well. And then again, if you do that lump sum because you're essentially taking your spouse off as a beneficiary, you can change whatever you want with that IRA. You need a spouse consent to get that done as well. As far as how do they actually calculate, they look at the interest rates to determine what that net present value calculation is. And we look at that top of the screen, that seesaw. Just keep in mind when interest rates go down, your lump sum comes up. When interest rates go up, your lump sum comes down. And we saw some of the best, lowest interest rates ever during the pandemic. Those were artificially low because that pendulum swung so far to that side. Then it swung the other side, and we saw interest rates kind of climb up quite a bit. They came down, came back up. They're kind of coming down a little bit right now. But depending upon if you're hourly or if you're management, they're going to look at for hourly. You're going to have that update. It's going to be once a year based upon the October rates. If you're management, it's going to be on a quarterly basis. So we can go into all the details. Taking a quick look at this, I just noticed before doing this recording, so I apologize. Whoever on the team put the chart together, I don't know why, but you'll see we're missing October from last year, from 2024. The 1 month that matters. If I recall, the second segment was about 5.04%, so it was kind of between that September-November time frame. And those segments are important because they correlate to different years of retirement. The first segment's going to be the first 5 years of retirement. Second segment's going to be years 6 through 20, and the third segment's going to be years 20 and beyond. And so for most of us, that second segment is going to have the highest weighting because it covers 15 years. So again, you'll see that, or you won't see, but it was about 5.04% that second segment for October last year. We are here in October. We haven't gotten the September rates out. We won't get the October rates until late November. But again, that rates right now is a little bit higher than that 5.04. It's trending to come back down close to that. So it's going to be pretty similar this year versus next year as far as the hourly option for those of you. So how do they calculate that out, and what do the interest rates mean? So I kind of told you that seesaw pattern. When interest rates go up versus down, it's going to change things. Let's look at it in a form of a mortgage. So it's similar to a mortgage payment versus what house you could afford. So if we look at that top line there, let's assume you can only afford $19.50 to cover a mortgage payment, or let's assume that your annuity is going to be $19.50. If interest rates were 4% on that left-hand side, it's going to afford you a $408,000 mortgage, or they're only going to give you about a $408,000 lump sum. On the right-hand side, if interest rates were lower, about 3%, so 1% lower, you're able to actually afford a bigger house, about $462,000, maybe not necessarily bigger, but more expensive house. And then that's going to actually increase your lump sum. So this is kind of what we saw, again, more severe than this, but during the pandemic, interest rates went really low, so the lump sum went really high. Then post-pandemic, into 22, the interest rates went really high, so the lump sum started going down. We're kind of in that leveling off phase right now. We're getting more towards long-term interest rates to be consistent. So again, any questions on there, give me a call. We can kind of run through your specific situation, look at the timing aspects of retirement and how to elect that lump sum if you are doing it and how it affects the interest rates. As far as the cash balance plan, unlike the defined benefit plan, that cash balance plan, you see what your lump sum is. It kind of works backwards. You're going to see what your lump sum is on a daily basis when you log in and look at that cash balance plan value, because that's what's yours. You can take it with you. But if you say on the opposite, hey, I'm concerned I want that annuity, you can then use the net present value calculation to look at generating an annuity. So it may be that you have a $600,000 lump sum. You say, I want an income annuity. Maybe they go through and calculate that's going to give you $2,800 a month for the rest of your life. And you get that option to kind of choose between one or the other. And so this one's based upon annual interest credits. And so what happens is, again, if you're hired after 2013, you're going to go in there. They're going to be making contributions on an annual basis between 4.5% to 10%. We'll show you in just a moment. And then it's going to grow at 3.3% or higher, depending upon where the CPI-U is for that previous year. So the age banding we talked about, they look at what your age and years of service is. So on the left-hand side, let's assume somebody's 45 years old, and maybe they've been there for 5 years. Okay, so 45 plus 5 years is going to give you 50. So they're right there on that top of that cusp of age of 50 points, which means they're going to get a 5.5% contribution from Merck. Again, this is outside the 401k. This is the cash balance plan. So they'll get, let's say you make $100,000 for simple math. Merck's going to put in $5,500 in there, and then that's going to grow by 3.3% minimum. But in reality, it's going to be a CPI-U plus 3%. So if the consumer price index for that year is going to be 3%, it'll be 3 plus 3, so it'll be 6%. You get a 6% growth. So it's going to be a little bit higher or lower every year, depending upon where inflation is. So this is one where actually interest rates going up can benefit you in the cash balance plan. It hurts you in the lump sum. So again, important to know, because when you decide to take your distribution, you need to give us a call so we can kind of go through which one you're under and which one affects you based upon interest rates. So in that same case, that person that was 45 plus 5 years, next year they'll be 46 plus 6 years, so they'll have 52 points. So they'll jump into 6.5% contributions for the next year. So again, you see it grows, and as you get over 70 points, so let's say anybody that's been there for 50 years and is 50 years old and is about 20 years of service, an example, they're going to get 10% contributions. So again, the longer you've been there, the more attractive that is, and the higher that contribution is going to be on there as well. As far as on that CPI-U, again, this chart gives you kind of the breakdown of different consumer price indices, different inflationary numbers. The dark red is going to be the CPI that they use. If we see going back in around 2020, that bottomed out flat. So if we have a flat or even like a negative inflation or deflation, then you're going to have that 3.3% as your minimum. But if we look at it right now at 2.9%, so let's just round up, let's say 3% plus 3%, you're getting about a 6% contribution. And again, we saw back in 2022, it spiked up a little bit higher on there. So again, you had some really good growth around 2022, 2023, because again, that higher inflation was a big benefit for the cash balance plan, as it was a hindrance on the lump sum. I'm assuming on the defined benefit plan. Another item to talk about on there, and I kind of failed to, we didn't have a slide on it, is it depends upon also how much am I going to collect on that pension. There are age penalties, so you got to keep in the back of your mind. You want to make sure you make it to 50 plus 10 years to be eligible for it. But 62 is the where you get 100% of it, having 10 years, or 65 if you without having to worry about that. And there are age penalties that drop down 3% a year. So again, it's important to kind of go through those as well. This slide just right now, about 3/4 Americans over 50 don't have a written financial plan. If you can spend about 5 to 10 minutes with us gathering some of the data I just talked about, in addition to your 401k kind of spending desires and things like that, we can run a full detailed financial plan for you, help you to kind of determine, okay, Wesley, am I going to retire this year or next year? Should I take the lump sum? Should I take the annuity? What should I do with my 401k? We go through all those different scenarios, and we can run multiple scenarios side by side to show you how everything kind of lays out and help you determine what it looks like, not just now, but the next 20 or 30 years into retirement as well. So again, give me a call. We'll be happy to kind of go through this with you on a one-on-one basis to give you more details of your specific situation. And then why the retirement group? I know we've been doing these seminars for a long time, webinars for a long time. We've actually been working with corporate employees for over 30 years. Our primary goal is to help you prior to retirement, help you understand the Merck benefits plans, and make sure that when you transition, you maximize all the benefits they give you, whether it be understanding the 401k, the pension, healthcare retirement medical benefits, life insurance continuation, things like that. Myself and some of our other advisors are focused on specific companies, so we know those plans inside and out. We can kind of guide you through that process. And then hopefully at the end, when you do decide to retire, you just throw our hat in the ring when it comes time for hiring an investment advisory firm. And we've strengthened that firm in the last 2 years because even though we've been doing this for over 30 years, we actually joined forces with Wealth Enhancement Group last year, which is a much bigger registered investment advisory firm, one of the big ones out there, over $110 billion under management, about 150 plus offices across America, 600 or 700 advisors across America. So rest assured, if you need to sit down with one of us face to face, we can likely accommodate you. Otherwise, we can do web meetings, phone calls, email communication, whatever your preferred method is. Just let us know. And then obviously that cash flow analysis I talked about before, take us up on that complimentary review. That will allow you to see where you stand and help you determine what the next steps could be. Even if you don't decide to work with us, it at least gives you a good confirmation or look at where you stand and gives you some guidance as to what those next steps could be going forward in retirement. And I'll leave this up here for a little bit. Take on looks like 2 questions in that I'll tackle. But if you have questions, you can reach us at info@theretirementgroup.com. You can call us at 800-900-5867. Ask for me or one of the other Merck focused advisors. There's a couple QR codes up here you can use to get into either our schedules, or if you want to get into our LinkedIn page to follow along more appropriately with the more Merck specific material. And again, a quick reminder, even though myself and some other advisors here, we've worked extensively with Merck, does not mean that we're endorsed or employed by them. But again, we can definitely go through any questions that you have and dig into that and kind of shed some light on some of those different options. So first question here. If I retire at 57 and take the pension, does that age 55 rule count towards me? This is actually kind of a good question because this is the age 55 rule. You maybe picked it up from us or somewhere else, but that's a rule on 401ks, not for a pension. And so the pension, depending upon how you take it, may be a moot point. So let me kind of dig into that. So the age 55 rule, what that means is, typically speaking, if you retire or if you tap into a 401k or a pension, pension lump sum prior to age 59 and a half, or an IRA prior to 59 and a half, you'll have taxes plus a 10% penalty. So the age 55 rule is a way to get around that 10% penalty. If you retired from Merck or left Merck, for whatever reason, the year you turn 55 or later, you have access to the 401k without that 10% penalty. So I think, let's say if you're 57 in this case, then yes, you can tap into your 401k without a 10% penalty. The pension, however, is different. If you took the pension as an annuity, there's no 10% penalty, even if you took that at age 45. If you have a lifetime income stream, there's no 10% penalty based upon the IRS. Now, however, if you took that pension as a lump sum and tried to take a distribution from that, then that's where that age 55 rule may or may not take place. Now, if you were to just take a direct distribution from the pension or roll it to an IRA and take a distribution, then no, you don't have the age 55 rule if you hypothetically rolled it into the 401k, you could potentially qualify for the age 55 rule, but we have to kind of get into that, into the weeds one-on-one and see if that's really truly the best option for you. Most individuals hopefully have saved something in their 401k, and we would keep that separate from the pension for more flexibility and better investment options, for you there. Another question here. I'm 60 years old, and should I keep waiting, or should I take the lump sum now if I think interest rates are going to change? Okay, I had that chart on there, and we talked about that seesaw effect as far as interest rates, how they change. We're at a unique time period where it might be more beneficial to wait because, like I said, we've seen the interest rates kind of swing back and forth. They came up quite a bit last year. They came down a bit, came up, and now they're on that route going back down. We saw the Fed cut rates, and that's not a direct correlation to where these bond rates are going to be, but it does kind of help lead the way. So if we see the Fed continue to cut rates, we may see some of these interest rates come down a little bit, not as dramatically as what we may see those short-term rates, because again, those are short-term rates where these are going to be short-term, mid-term, and long-term rates. But if those interest rates come down, it's kind of a double benefit to you, because if you're 60 and you're not 62 yet, that's where you get the full 100% of your lump sum. So just simple math, at 60 you're 2 years shy. It's actually a quarter point reduction per month, so 3% a year. So in this case, that person that's 60 years old is only going to get 6% less, so 94% of what their pension is going to be. And if interest rates didn't change whatsoever and they just aged out of that, they're going to get that 3% bump each year. But if interest rates were going down, they could get 3, 4, 5% bump on that. Now on the flip side, you got to compare the opportunity cost. What could I do with, let's say that's a $500,000 lump sum. If I didn't do anything and I knew interest rates weren't going to change and I get that 3% bump, that's 3%, but I could go out there and probably get 4% in money markets, or I can get 4.5%, even 5% in a longer term CD or annuity. So I could actually be better off taking that lump sum and investing it even in something that's guaranteed. Or I might say, well, I think that I can invest this in the market or even a conservative portfolio and do better than that 3% growth. You might want to factor that in there. So again, it's important to give us a call to run through this side by side and kind of go through different assumptions of performance and opportunity costs on there as well. So good question, but again, more of a one-on-one if you want to dig into that. So like I said, any questions, feel free to give us a call at 800-900-5867. Ask for myself or any other advisors that help with Merck. And again, if you have any questions, you can reach at info@theretirementgroup.com. But I appreciate everybody taking a little bit of time out of their day, and we hope to see you guys soon. You have a great day.